So thank you for taking the time. I'm very excited to talk to you because I can see from your background that you have deep expertise in this area. Chair
in banking and finance.
So I thought, let's just start with sort of a question. What do you see as the systemic causes of these 3 bank failures?
I don't want to use the word systemic. I'm going to be a little bit of a professor about this because I've written about systemic risk, and we have very definite terms of what that means in terms of it being an overall effect that impacts the entire banking system. This is not that. Just in parentheses, systemic risk is what causes financial downturns. I have a paper where I can measure the risk of economic downturns. We could predict macroeconomic declines, recessions, 6 to 8 months in advance based on systemic risk. That's not what this is. This is old-fashioned interest rate risk. It's the oldest risk in the book. In fact, when I teach it to the undergraduates, I start with it because I said, this is the easy stuff. We've been dealing with this for decades. We know exactly what to do. It's not rocket science anymore. And before we get to the more complicated credit risk and operational risk, let's get the template using interest rate risk, because that's what we follow, that history, which really dates back, I would say, to the 1970s in earnest, probably before you were born. And so when we started to develop more modern tools to deal, interest rate risk dates back as long as banking exists, but to deal with modern tools of risk management, I'd put them back to the 1970s when the options markets were born. So this is nothing new. So that's the first thing. And the second thing that's in common, so I'm not going to use the word systemic, but I like to use the term that there are things that are in common in terms of these different events. There are things that are very different as well. But the thing that let's talk about SVB and Signature, as I imagine what you're thinking about. Credit Suisse, of course, is today's news. But SVB and the Signature have in common that a bank cannot survive a bank run. Bank runs are fatal. That's it. Game over. Bank run will cause the bank to go out of business, and it should in some sense, because it's a dramatic loss of confidence in the bank. It no longer has its reputational charter value or reputational capital. And so we've got to change management. And that's what going out of business is all about, changing of management, because the bank doesn't go out of business. Even Signature and SVB are not out of business. They just are doing business as an FDIC controlled entity. So the thing that they do have in common is that they were both subject to a bank run. Now, you might want me to talk about what that means, a bank run.
I do know what that means. It means that people basically depositors got the sense that they saw the call for capital and they rushed to take their money out, and therefore the bank has no liquidity. Yeah.
Right. And by definition, a bank cannot survive that because it would require having dollar for dollar cash hanging around just in case you experience this dramatic effect. And then the bank would go out of business, not because of the bank run, but because there was no money in it.
Yeah, right.
So either way, it's going out of business. So, okay, so then we're on the same page. So I can keep talking, but maybe you should ask the question.
Yeah, sure. So one thing, what is the risk for contagion in the industry?
So I don't think, so that's an easy and a difficult question. Again, I don't think there's risk of contagion in the classic sense, meaning that one bank's failure will take down other connected banks, in the sense that, other banks had money, let's use a simple example. other banks will have deposits at SVB and Signature. And because they are not going to have access to their money in a ready form, then they will have problems, and that could cause them that domino effect. I don't see that at all. But I do think that there's a contagion effect, and I'm coining a new term. I don't know if anybody's going to pick it up. I'm calling it a meme bank run. We all love memes. And I do believe that the contagion is not our classical contagion anymore. It's the meme effect. It's the GameStop effect. It's everybody's talking about it. And so I better go and check my bank balance, and I better worry about my bank. And you know what? I better be safe. If I'm a CFO of a medium or small size company, why do I need the headache for? Let me just take the money out and move it somewhere else. And that, I believe, is the story of Signature more than SVP, because SVB was, I guess, the first, you could say. Signature, to my mind, is a meme bank run, because Signature did not have the same underlying problems as SVB does. It did. So maybe I should talk about those underlying problems first.
Absolutely. Yeah, let's go over those underlying problems of
Okay,
it.
so let's talk about what brought down SVB and why I say this is the oldest risk in the book, not the oldest profession in the book, just the oldest risk for a bank. And this question of what is with interest rate risk, because banks by definition are going to be borrowing short to lend long. The idea being, thinking about it, they borrow money on a day-to-day basis and they put it into loans, which can have a 5-year or a 10-year or a 30-year time to maturity. That's how they make money, because they earn a higher interest rate on the longer term loans and they pay less for the short-term borrowings. And that's the spread. That's the business of banking. And fine, it's what enables them to do that and to provide these services to both the borrowers and the lenders. And so, the depositors, let's call them. So that's just the way it is. But what happens when interest rates suddenly shift, either going down or, as in our world currently, going up? Now, interest rates, when they go up, this is bad news generally for banks that have this long-short position, because their long-term assets are going to be written down a lot, but the short-term liabilities won't. So they're going to lose a lot in their asset value, and their liabilities will not go down in value. We know equity value is just the difference between the market value of assets minus the market value of liabilities. They're going to take a hit to their stock price. They're going to lose equity value. And that's exactly what happened to SVB. They had a huge exposure to interest rate increases. I mean, just to get a little technical, and I pulled some of their latest disclosures, they had duration, they had a huge duration gap. The duration, which is just that, think about it, I use the term long maturity, but that was not really correct. I give my students grief about that, but it's long duration. The durations of their fixed income securities went up from 3.7 in 2021 to 5.6 at the end of 2022.
And when you say 3.7 to 5.6, is that years or
years?
Yeah.
Yes.
And those were like those are securities, were those the bonds they were holding? Is that what you're
yeah, things like bonds and fixed income securities of all kinds, right? Because they did have bonds in that for sure. They held old-fashioned treasuries, they didn't have anything exotic in there on their books, but they had long duration. They're held to maturities securities, which are designated by the bank. Their duration went up from 4.1 to 6.2. These are big numbers. These are big numbers, especially for a bank that relies on a lot of day-to-day money. So what this is showing is they did disclose it if they are in their latest, I think it was their 10K at the end of 2022, that they had a huge exposure to interest rate increases. And that was causing their stock price to decline, because as the interest rates kept going up and up and up, and fighting inflation, and the Fed is continuing to tighten, that is going to directly go to their value, their stock price, their equity value. Now you can ask, why did they keep such a long position? And that's the business decisions of management, which ultimately turned out to be wrong.
Mhm.
It could have been a big win because was a very profitable position for them to be in until it wasn't.
Yeah.
So
Right.
if the Fed would have started to loosen up quickly, as they were betting on, they would have been the heroes. Now they're not.
They're not.
But that's business. That's why business is risky, and banking business is very risky. And to argue that, there shouldn't be any risk in banking means that we shouldn't have banks, basically. So that was SVB. They took the classic interest rate risk bet. They lost, out of business. That's
Mhm.
Now, where did Signature come in? Signature didn't have that interest rate risk bet. They were very conservative with regard to that. In fact, they had repositioned their books to make money when interest rates go up. So they were doing the opposite of the classic banking position, because look, this was not a surprise that interest rates were going up. So it wasn't a business decision. The SVB bank management took a bet that interest rates would stop increasing, that the Fed would stop tightening. Signature took the opposite effect. The bet, Signature was right. They didn't lose on that. They didn't. So the question is, why are we talking about Signature and SVB on the same discussion? And that is because of the meme bank run. So what happened with Signature was they lost around 20% of their core deposit base. And that was not unintentional, that was intentional. They started throughout 2022 seeing the crypto. Again, this is another slow motion crisis. That's the thing that gets me. All this stuff was in position for a year, certainly for several months, an eternity in the world of finance. So what happens? We see that they're reading the signs. Signature bank managers are reading the signals. They read the signals of the Fed continuing to tighten correctly. They read the signals that crypto was falling out of favor. We have a crypto, they call it a crypto freeze, and they try to get out. And they had moved into that business, so they decided to get out of that business. They actually had teams of clients that manage client relationships, which is that essentially convince their crypto customers, their crypto clients, to leave the bank. And they were successful. They lost 20% of their core deposits that way. So what happened? What happened? Well, that meant that they had a lot less liquidity, a lot less of a cushion. In fact, their loan to deposit ratio, they're basically a real estate bank, and they're basically a New York area bank. And so they make a lot of loans that basically most of their loans are real estate based, either residential or commercial mortgages or mortgage-backed securities or construction loans. That's basically their business. Their ratio of loans to deposit went up over 80%. So they had very few securities, marketable securities available to meet a liquidity crunch. And what happened was people started saying SVB was a crypto bank, Signature is a crypto bank. Maybe we should think about the security of our money. And this was a case, and I know of a case of one zip code in the New York City area that over the weekend, right before, they really, I guess last Friday, pulled $1 billion worth of deposits out of Signature Bank. This was social networking to create a bank run. This is why I'm calling it a meme bank run. I don't think Signature deserved that in some sense, they didn't have the same fundamental problems as SVB, and they were solvent. Not only were solvent, they were pretty profitable, though their stock price had been going down over the last year, but also bank stock prices have been going down over the last year because banks don't live well in a world of raising interest rates. They don't do well in that environment. But Signature had repositioned itself to do well in that environment. So what happened though? No bank, no matter how well it's run, is going to withstand a bank run.
Now, one other thing on my mind, because I did read that many of the deposits at SVP and at Signature were above the $250,000 federally backed.
Right.
So
that's who ran. Those are who ran. The under 250,000 don't have any incentive to run. So go ahead.
right,
yes.
right. So I guess one thing I read was that these banks were allowed to have many, in the case of Silicon Valley, most of its deposits were, over this threshold, and therefore people, felt more vulnerable than those who were safe. So was there something that banks, that the regulators should have been telling banks, like, you have too many deposits over $250,000?
No, Bonnie, I have a big problem with the way you phrase the question, because what does that mean? They were allowed to do that. They have customers and they serve their customers. A business, of even a small business, $250,000 to have as the working capital of your business is nothing. I mean, even a small and medium-sized real estate firm has to have that money ready to be able to do business. A construction firm certainly has. So again, this is not a regulatory question at all. It makes this and in fact, if anything, regulators mucked up the problem, made it worse, because a lot of these losses, and certainly on the SVB case, there were losses that were the ability of SVB to actually meet the initial withdrawals was hampered by regulations that were not beneficial. I mean, we could go into that if you'd like, but that's a side point. But it has nothing to do with the $250,000 limit. The $250,000 limit is a limit on deposit insurance, and if an entity doesn't feel the need to have that deposit insurance, then they need more ready cash in an account, and the convenience of having it in one account as opposed to spread over 10 different banks is beneficial to them. Then it's not the business of the regulators to say no. And so,
okay, I'll buy that. So actually moving along, because in the case of Signature and Silicon Valley, the federal government has said that they will, back or make whole depositors over $250,000. Why did they do that?
So this is part of a process that we see in which the federal government or the Fed is backstopping the entire business world, in my view, if not certainly the financial world. So what we had was a case where there were going to be losses. So let me stay the pro. There are pros and cons to everything. So what's the pro associated with that? And it's a bona fide point. The tech industry is having its difficulties, and it's certainly a critical industry, not just because of employment and GDP, but because of the future growth of the entire economy is tied up with tech developments. And the tech companies that were the lion's share of SVB's large depositor base would have had serious problems. Because even if ultimately they would have seen the money, which probably they would have, this is money, again, remember what I said earlier, why do these companies hold money more than $250,000 in the bank? It's because it's their working capital, it's their day-to-day, it's their checking account that they use to pay their workers, their employees. It's what they use to pay their suppliers. They need this money to keep the business growing and going, never mind growing, just going. Think of a body, a human body, and all the organs can be healthy, but if the blood doesn't circulate through the body, then it's not going to survive. Same thing with a business. This working capital is the lifeblood of the business. So it would have created definitely a tech, probably a recession. And that could have, of course, that would have spilled over into the general economy, no question about that. So that was the reason why they would do that. And you could say, in the long run, we're all dead, so forget about the long run cons, because that's what I'm going to talk about now. Because the reason why I am not in favor of that, and what I excuse me, and why I would have liked to see the government handle that problem, the tech industry decline problem directly, if and when it occurred, is because we have created a presumption in the business world and certainly in the financial world that heads I win, tails you lose. Heads I, meaning the banker or the finance professional, I win. Tails, if I bet wrong, you, the government, and by that extension, of course, the taxpayer, you lose. So you can never lose. And that means there's no reason for any private bank or financial business to manage risk. Just roll the dice, flip the coin, and heads I win, tails you lose. Now, this has been a problem that dates back to the 1980s. I'm going back, I'm dating myself, when we had the thrift crisis. I mean, indeed, the thrift crisis came about just in the same way as this. So if you really want to go, I know all the financial press is talking about 2008 and looking for a parallel there. It's ridiculous. If you want a parallel for an earlier crisis, go back to the 1980s, to the thrift crisis, the asset savings and loan crisis, because that's the thing that's common or in common with it. But in terms of this, I think we have already, and this is, we created with the pandemic. And again, that was another, there were always good reasons to do these things in the short run. But in the long run, we create an expectation that is very dangerous to business and will create more and more risks as we move forward, and prudent and expectedly so, because if there's no reason to be prudent, why should I, right?
Yes.
So that's my fear. That's why I would have much preferred another way to deal with the ultimate tech, problems that would have broken out as a result of letting SVB actually go under.
And just a side note, when you compare this to the 1980s, and you're basically saying because the 1980s we had a similar sort of sharp rise in interest rates that
Exactly.
make banks vulnerable.
That's exactly, and these thrift institutions had the same classic picture that SVB did: very long duration assets, very short duration liabilities. When interest rates turned up, it was a losing proposition. They were losing money from directly to their bottom line in terms of equity value. Equity went down. At that time, it wasn't marked to market in the sense that the market didn't necessarily know that. It wasn't a stock price reaction right away. It was hidden. And in fact, the connection is actually even better. I didn't think about it until then. As a result of that, and this is, they get, you're going to edit this stuff, right? So
absolutely.
Yeah, because now we're just talking, but it just occurs to me. It's an interesting point, and I haven't seen anybody else talking about this either. So the thrift crisis, this was, again, the classic: interest rates go up. We all understand the value of the assets go way down. The value of the liabilities doesn't. That causes a decline in equity value. The difference is that the thrifts were not marked to market, meaning that it was all book value. Accountants love book value because it's clear, it's easy. I know what I paid for something, that's it. But in finance, this is like ridiculous because we are always looking forward. We're not interested in what I paid for something last week or last year or 10 years ago. I'm looking for what its value is now. That's the market value. So the thrift crisis made it clear that there was a problem with book value accounting applied to businesses like banks. And so, because basically these were insolvent banks that were continuing to operate as if they were zombie banks, so the living dead banks. So, so what the regulators started to do was to change the rules about mark-to-market accounting. But of course, the accountants didn't like that. So it became the usual, compromise. Instead of saying, okay, look, this is very nice. I know you can figure out historical value, and market value is a little tough to figure out. We have ways to do it. Maybe talk to your finance professors, but you accountants. So no, but okay, but we can't do it as accurately as you do when you look back with 2020 hindsight. But okay, so we're going to allow you to mark to market a portion of your assets, but we're going to allow you to keep a portion of your assets in book value accounting. That portion is the held to maturity portion. They're designated to be held to maturity. The others are available for sale. There's another category, but it doesn't matter. So there's really available for sale and held to maturity. Available for sale is marked to market, so that if their value goes down, it immediately gets charged off against equity. And held to maturity just keeps the fiction going. Whatever you pay, that's what it's worth. Now, it's up to the bank to designate what's held to maturity and what's available for sale, right? So now, I can see you get it. If I'm worried about assets being marked down, I'm going to stuff them into my held to maturity group. And that's why, remember I told you the held to maturity bucket as of the end of 2022 for SVB had a huge increase in their duration. That was because they were putting all those long duration bonds into the held to maturity so they wouldn't have to write down their losses. But what happens now? They've got a liquidity crunch. They need the cash. And if they would try to sell those held to maturity, they're going to pay all these fines and fees and all of that to the regulators, because after all, you said you're going to hold it to maturity. How dare you sell the thing?
Got it.
So
Got it.
So all that stuff was inaccessible to them. They couldn't sell it. So here, it makes my mind explode a little because we created this. I don't think that they would have been able to withstand it anyway.
Right.
But what we're seeing is that what this regulation would do is take a small crisis and blow it up into a bigger crisis. Because for other banks that have some exposure, but not a huge amount of exposure, they might be able to make it through.
Right.
But they can't touch that portion of their securities because of the fines associated with selling held to maturity assets.
Right. Really interesting. Okay. This is great. I'm trying to see, just a question. What, and I'm curious your answer, what could or should regulators have done to prevent these failures, if anything?
SVB?
Yeah.
Well, I'm not sure that they could have done anything. Because
I guess
I don't believe they could have done anything.
Because I guess from what I've read, of course, it seemed like, for example, Dodd-Frank was the threshold was raised and things like that.
Remember, again, this has nothing to do with Dodd-Frank. It has nothing to do with all those regulations, because these guys lost money in the old-fashioned way. It was interest rate risk. Everybody's forgotten about interest rate risk. No regulations were dealing with credit risk.
But the stress testing that these banks go through, like the big banks go through,
Yes,
that
they do.
if So you're saying that stress testing would not have picked up that this bank was way too exposed in.
Oh, you didn't need stress testing to pick it up. This is, this was not, it was not hidden, it was not subtle, it was there. It was a decision, it was a business decision of that management.
Yeah.
But ultimately, I mean, again, when I'm talking about, flipping that coin, I mean, they made a business decision that could have turned out great for their stockholders, but it didn't. So are we going to outlaw making bad business decisions? Well, then that means we have to outlaw business decisions entirely. We can't regulate away bad business decisions. And we can't regulate away, and we shouldn't regulate away the consequences associated with them, because this management, they took a bet and they lost. So they should lose their positions as a result. They made a bad business decision. They should pay the price for it. So the role of the regulator is not to protect the stockholders and the management of the company that makes a bad business decision. It's to protect those other innocent parties that are brought down by it, like those tech companies that don't have access to their accounts and therefore can't make payroll.
Right.
That's why I said earlier, that's where regulators have something to say, not in preventing the bad business decision, because that assumes that regulators can make only good business decisions, which I'm not sure is in evidence at this point. And since we are all fallible, and I don't believe I don't want to talk about all my bad business decisions in my lifetime. So I think the only way you can avoid bad business decisions is by not making them. And business decisions. And so this is not a regulatory fix.
Okay.
Definitely.
Okay. So, and just going back, because you said, I very much understand what you said about sort of this government bailout, if you will, being kind of like heads I win, tails you lose. But weren't the depositors, like the Silicon Valley companies, I mean, they're basically the innocents pulled into this mess, right?
Yeah, so to a certain extent, yes and no, but yes, that's why when I said, what I would have preferred to see in terms of intervention would have been, okay, we see that we have a problem in the tech industry, payrolls are not being made, businesses aren't able to pay their bills, they're at risk of failing themselves. Let's talk about some sort of a line or some sort of or what I actually, when it first happened, I had an interview with, I forget who, I never remember who I talked to, but, and I said, I don't know why there's not a purchase and assumption. The FDIC does this all the time. There are plenty of very, very solvent banks, some of whom are even in the Silicon Valley area, that would love to get their hands on the assets of SVB. I don't understand why there wasn't a same day P&A, purchase and assumption of the business. That would have been, to me, the simplest thing. First of all, you get rid of the managers that made, and the shareholders that made the bad decision. So there is consequences to their action. But all the counterparties, all the innocent bystanders, like those tech companies, are made whole because now they're doing business with a new bank. And they're not getting 100% FDIC insurance, but they're getting the same bargain that they got when they opened up their accounts with SVB. That's the way we always talked about resolving these bank problems. For some reason, and this is on the FDIC. That's the FDIC's bailiwick. For some reason, they've forgotten how to do it. I know they put a lot more legal bells and whistles into purchases and assumption, because the fear was that some purchases were going cheap and there were people getting rich on them. There will be people getting rich, as there should be. This was a valuable bank. It had valuable assets, and it's being sold at a fire sale, right? So that's why I don't understand why it still hasn't been taken over, because this stuff is ripe for the picking.
Yeah.
When in 2008 we didn't have, and see, that's why I push back on your use of the word systemic risk. So you could say systemic risk is when there are so many other banks that are in their own financial difficulty that there isn't enough ability to pick up those very yummy assets at fire sale prices. I am sure that there were a lot of expressions of interest, not only from banks, hedge funds, and venture VCs, venture capitals firms also are in that business. There's a nice paper by Manju Puri where she says that they really do a very good job of turning around troubled bank assets. And so that's their findings, using FDIC data, by the way. So, we didn't have to reinvent the wheel. I mean, I guess the advantage of being so old is that I remember how things were done. And for some reason, I think we've all forgotten. So
Yeah,
that would have been much preferable to even a special deal for the tech company. And certainly would be more preferable to extending deposit insurance to everybody.
yeah, because that's unsustainable, it seems.
It's sustainable. It's sustainable on your back and my back. We're going to just pay the taxes for it.
Yeah, that's right. Well, I mean, because the government keeps saying, that's my final question is, because the administration is saying we're not using your taxes. So how are they funding this?
Money is fungible, so
Okay. Great. I think this is, I mean, you've been so helpful. Was there anything I didn't ask that you wanted to talk about?
About everything.
That's about everything.
No, maybe you should tell me